And now we end off with the finances. We will start with assumptions. The first group of assumptions will relate to your savings plan as well as your investment plan. You should already have this detail, as you would have discussed and decided on these factors at length during the first 3 steps of the process. The escalation percentage relates to how much you are willing to increase your individual contributions on a yearly basis. Once you've drawn up this table, then you can decide each year how much you can individually afford to contribute. Your financials tracking template should be able to tell you the estimated impact of your decision. We will go through building this template in detail during this section of the tutorial. Next, based on your investment strategy, decide how much of your savings you're going to allocate to each area you've decided to invest in. At this point, you've already done your research, so you should already have an idea or estimation of how you think each area is going to perform over the next few years. This should be based on a combination of historical data or reports you may have read and whatever expert advice you may have been able to get. You will have to review these assumptions and estimations often in order to make sure that they reflect changing conditions and any developments that are happening externally. These developments may include external factors such as political instability, where the markets may freak out across industries to the point where the balance risk within your ETF starts to go haywire. The industries your performing shares are in can suddenly become volatile, while the others are simply not performing. There may be internal factors to consider as well, such as infighting within the group, wherein a couple of members decide to put in notice to exit. Life happens, and not always as planned, so be prepared to rejig your plan every now and then. The allocation is broken down into 2. How you're going to allocate your capital, as well as how you're going to allocate your contributions. As you can see, this plan assumes that you'll work on your savings plan in year 1, then proceed to implement your investment plan in year 2. Based on your contributions, you may only have enough for cash and stock investments as per the allocation in year 2. You may also decide to exercise prudence and implement your investment strategy in a staggered approach. Introduce a new investment area each year to pace yourselves and iron out any coordination issues. Perhaps the property market is not making sense and you fear being trapped in a bull market, and so you rather choose to wait and focus on cash and stocks. You may also decide that you want to have enough cash available for any unanticipated member exits, but choose to allocate more of your contributions that year to ETFs as they are performing better. It is entirely up to you, as long as you've worked through the logic together and it makes sense for your particular context. In this instance, we can only start entertaining property in year 11, because that's when there's enough capital to actually buy and fully own a property as a group and a business. As mentioned before, it entirely depends on what your savings plan and your investment plan is, and according to your particular context. The next set of assumptions relate to projected returns. For cash investments, your research should have told you what banks are willing to offer for a certain amount over a given period. It may be prudent to fix your cash in cycles of 12 months for better returns, while also getting the flexibility of having access to your cash at least once a year, so that you can shop around for the best offer for that year and also be able to pay over any exits or add to your capital via new members. For stocks, it largely depends on past performance data. As the experts say, these things tend to be cyclical, so you can make some assumptions based on that. The advice is to be modest. Just because a particular ETF returned 14% in 2014 doesn't mean it's always going to do that. Take the average and revise it down slightly. Some years may dip, some years may see amazing performance. So choose an estimation that can realistically capture and average out these variations. Follow the same approach with property. According to experts, property is less volatile, so it shouldn't be too difficult to make estimations accordingly in terms of equity returns. The same applies for rental returns. You will have to update these every now and then to reflect the state of the market in terms of property values and rental returns. Lastly, fees. We've taken a very simplistic approach to estimating the fees and any other costs associated with your investment adventure. We've calculated the fees as a percentage of the total portfolio contribution for that specific investment area. Assuming we now start investing in year 2, opening up stock trading accounts and moving money from this bank to the other will attract transaction costs. There are also taxes and other trading-related transaction costs associated with trading ETFs and stocks. You will see a breakdown of these on your trading platform invoice every time you make a trade. Sometimes you might have to pay for advice or counsel from properly legalized investment practitioners. Get the advice, pay them for their service and counsel, and go back and DIY. Don't hand over your money to anyone, please. Arm yourself with knowledge and use it to empower yourself for future generations to come. Don't be lazy and expect miracles. That's the fastest way to disempower yourself and make some chatelaine rich with your money. In the context of property, municipal rates and taxes, as well as property purchase costs, are pretty standard concepts that are part of the process of purchasing and owning a property. The maintenance costs could, at the beginning, be things such as insurance, paint, fixing broken locks, and plumbing, etc. Over time, this can include adding extensions to a property where applicable to increase rental revenue. We've made provision for these costs on a yearly basis as a percentage of property value. The situation won't always be as linear as projected here. You might burn through your budget one year due to unruly tenants who damage your property and even end up exhausting your entire rental yield, and then be in a position the next year where your only costs are carpet cleaning and gate locks. So just be mindful of that. Don't be tempted to use the money to throw celebration parties because your properties are in tip-top shape. There's always unexpected maintenance expenses that crop up every now and then. There's a market out there for stolen second-hand barracudas, for example. Right, so now we start with the breakdown of your financial tracking for year 1. This is when you're basically starting to save at 250 Rand each, assuming your group has 6 members. That will generate a monthly contribution of 1,500 Rand for the group. Based on our table of assumptions, the cash savings interest at year 1 is 4.5% per annum, as reflected by the interest line. Next is the fees, as estimated in our earlier table of assumptions. Remember, in year 1, we didn't account for costs because some banks will offer you a zero maintenance fee account if all you're doing is putting money in the account and letting it accumulate. From year 2 onwards, we've calculated the transaction costs as a percentage, hence the spread. It averages out to around 66 Rand per month. This is just to avoid hard-coding values into the yearly calculation. We drive all the updates from the assumptions and estimations tables. It will make life a whole lot easier and aid continuity during your management structure rotations. At the end of year 1, your total capital sits at around 18,400 Rand. We've assumed for purposes of this tutorial that we diversify from year 2. So at this point, we're starting our investment journey, having spent year 1 getting our house in order as per the first 4 lessons of this course. We take our capital and split it between cash and stocks. The brown line shows the capital growth per year. We start each year with a capital amount and decide how to allocate it between investment areas. As I said before, the process is not linear. It may be difficult or imprudent to sell off some ETFs at a given time because it's not the right time to sell, and doing so may result in value destruction. In that case, leave it alone and allocate the capital that is liquid at that moment. It's easier with cash because once you unfix it after 12 months, you can shop around for a week or two for the best rate before recommitting it for the next 12 months. It gets a bit complicated with stocks, so get the right counsel before deciding what your next move is going to be. The next line depicts your annual contributions with an escalation of 10% per year.